much. Let's get the big picture with Chris Wolfe, Chief Investment Officer for Merrill Lynch's Private Banking and Investment Group. He helps oversee $157 billion in assets. Good to have you back with us, Steve. Good afternoon.
Thank you.
Are you getting more bearish?
I think it's a great question. I think the markets are pricing in the long list of negative news that you hear out there, from worries in Europe, worries in the United States about debt deficits.
It's not just a list, though. It's real concerns.
Oh, I totally agree. I think markets are starting to price that in. I think where we're coming out, to answer your question, is, number one, for clients that are sitting on the sidelines with cash, we're asking them to be a little more cautious. There's going to be more opportunities over the summer. For clients that have way too much risk, ones that bought in 2009, 2010, we have a lot of them. We're asking them to pare back a little bit.
When you talk about risk, I look at the financials. Adam covers it. We have Zara covering it. I mean, they keep getting beaten down day after day. Yeah. Are you willing to take on the risk of financials at this point?
You know, I think we're in the midst of a transition in terms of how we value financials. They were growth companies all through the 90s and even parts of the 2000s as they brought in new business lines, mortgage lending, et cetera. We're transitioning to valuing them how they should be, on balance sheet metrics. And that transition is going to be painful and difficult.
Chris, let me ask you, a name like International Paper, not doing too shabby this year, up almost 9%. Do you like these kinds of names?
I think we like industrials, number one. Number two is I think the story around free cash flow, this profit margin, profit cycle story is very good. So while we talked a little earlier about the short term, really the summer slump, the long term, I think, cycle here is driven by how good profit margins are. And we expect them to stay high through the remainder of this year. That fuels M&A. I think that's part of the story around some of the industrials and some of the cyclical names.
Hey, I want to talk to you about technology, but before I do that, I want to bring Adam back. Because, Adam, you've been looking at the technology group, talking about valuations. They look pretty cheap here.
They're cheap. Well, as a matter of fact, technology trading at about a 9-year low. I'm sorry, an 11-year low, about 9 times cash flow. All right. But look at this. All right. Technology and financials are the two biggest groups in the S&P. Financials are down 6.7%. Technology, call it flat on the year. It's up a tenth. And yet the S&P up 2.4%. So, Chris, my question to you is, how can you possibly get excited? How can anyone possibly get excited about this market when the two largest groups that, by the way, account for about 30% of the S&P, if they're lagging?
You know, we've talked about that in the past, as this is difficult to call the market, but we think it's easier to look at some of the sectors. We've talked about global growth, the industrials, the energy names kind of benefiting from growth outside the U.S., benefiting from the weak currency. And inside the U.S., the consumer staple story, able to pass on some of those, let's call it price increases and preserve their margins. The bottom line for us is we're getting more selective, both around sectors and securities, trying to capture the free cash flow growth, the dividend stories, which are a result of that, and the M&A trade. I think that's the way you go forward in this market.
I mean, it's always a stock picker's market, isn't it? It seems.
There are times when the market, you can just buy it outright when there's lots of liquidity, kind of cheap valuations, easy as 1982, easier as 2002 at the bottoms. I think in periods like this where valuation measures are a little more confused, liquidity is set to go away later this year, and the profit cycle is good, you really have to be more selective.
You know, you talk about liquidity and you talk about QE2. I want to bring John Taylor into this because investor John Taylor, founder of the world's largest currency hedge fund, he says the risk trade is done. Listen up, everybody.
Our stuff is arguing that this cycle has turned and that because the government is going to cut back on fiscal stimulus, QE2 is ended. All of those things basically tell us that it's over.
Chris, is the party over?
Well, I think the liquidity party, which is what Mr. Taylor was talking about, is certainly set to get worse later this year. It's coming out of the system. So that's part of a story of being more selective. I think that has an impact potentially on valuations and how we look at risk in this market. It means volatility will be higher. It means you need to reposition portfolios around that. More diversification, and you want to be more global. There's opportunities across Asia, Latin America, and Europe that when we just focus on the U.S., we forget.
What impact do you think the ending of QE2 is going to have on the overall market, or do you think so much of the expectation already built in here?
I think a lot of it's priced in. We've already heard talk about stealth QE3 with the Fed drawing down Treasury balances, so it's already there. We might technically be looking at QE4. Anyway, the bottom line is this. I think a lot of it's built in. Our analyst teams have highlighted as much. From our perspective, we expect that to just be part of the feature of June, which is full of earnings pre-announcements potentially and more volatility on the political front going into the first part of July. So, again, more opportunities to reposition.
Hey, Chris, it's Adam. You talk about looking outside the U.S. What's your number one place to go outside the U.S. for opportunity?
You know, I think we'd be talking about a couple of places. I know you want one. I'd have to focus on South America, namely Brazil, in terms of the growth. But we'd also look at places in Europe like Germany, which we continue to find as relatively attractive, beaten down in terms of valuation. And I think if you want to get a little more aggressive, you can go to places like Russia. But the bottom line here is growth outside the U.S. from our perspective starts to look much more attractive when you look at the challenges the U.S. markets are facing.
What about the Peruvian markets? I know you're watching that pretty closely with the elections.
You know, that they went in a place that I don't think market watchers expected. You know, markets took a tumble. And I think the issue here is you talk about potential policy change around the copper miners. And I think the issue of copper supply being impacted, something to watch very carefully. Copper's been creeping up. I think if there's more restrictions or some kind of change in tax policy in Peru, we could see copper move higher as a result of that.
But we're not quite sure yet if that's how it's going to play out,
Not yet. We need more news coming from that. But the bottom line, Dr. Copper is still a good indicator of economic growth. And at the end of the day, still creeping higher.
Got to run. Chris, thank you so much.
Thank you.
Chris Wolfe, Chief Investment Officer over at Merrill Lynch Private Banking Investment Group. Got it. Okay.